Remember in last week's video, I talked about taking the money that you would save from refinancing your house and whatever portion that was. In our example, we used $100. And I was telling you to take that $100 and throw that right back into the mortgage and apply that to your principal. In today's video, you're going to learn why. So initially, I wanted to draw this out on a whiteboard and explain to you as I draw it out, but I actually found one that was very clean and much better than I would have drawn. It all starts with understanding the loan's structure. A majority of us, including myself, have a 30-year amortized home loan with a fixed interest rate. So understanding the way that amortized loan works will give you a better understanding why I'm telling you to take that money you'll be saving after refinancing your home and just throw it back into your monthly payment anyways towards the principal. Or it actually might deter you from wanting to refinance your home. I'm going to put a picture on the screen right now, and it's a very simple graph. The vertical axis is your monthly payment. The horizontal axis is the amount of years, starting with 0 all the way to 30. As you look, there's going to be two lines on the graph, one being interest and one being principal. This graph depicts the monthly payment and how much of that is going towards interest versus principal. And you'll see you're paying significantly higher, or the monthly payment is going more towards your interest than it is your principal. So if you do refinance your home, you're starting this entire process all over again. And that's what I want you guys to understand. I want you to know you are not paying down your principal on your mortgage for quite some time. So the more you throw into it, the shorter period of that 30 years you'll be paying. But not only that, you start to chip away at the interest that you'll be paying to the bank. And in the long run, that little goes a long way. If we can just cut off a couple extra years, maybe 3 to 5 years, you're saving thousands of dollars. And I can't give you an exact number because everybody's loan is different, loan amount, type, interest rate, etc. So I do want that to be clear. If you guys have any questions about any of this, I know that was a quick explanation with a very simple graph, but I did want you guys to be aware and understand that's how it works. That example is called, or this type of loan is called front-loaded interest, meaning you're paying a majority of that interest that you owe the bank up front. So they're always going to make their money up front. And if I were the bank, I would do the same thing. Hey, I know you've been paying your house for about 5, 6, 10 years, whatever it may be. It actually might be time for you to refinance your mortgage. And I would say that because it's front loaded, meaning the bank is going to get paid all that money all over again. And you're still not going to own that home. The bank still owns that house. You're still paying that principal down. So with that, I hope you guys have a better understanding of the 30-year amortized home loan. Even though it is a fixed interest rate, it's not simple interest. So I hope that really helped. If you have more questions or you want me to further explain this process, this loan, or questions about refinancing, please reach out to me and I will be glad to talk. I hope you guys have a great week and I'll see you next week.